Warning: refiners declined to buy 90% silver. Credit freeze, maxed out credit, Saturday, January 24th, 2026. The markets are closed, but something unprecedented is happening in the shadows of the precious metals industry. For the first time in modern history, refiners are refusing to purchase 90% constitutional silver, not because of price, not because of purity, but because their credit lines have been completely severed. When the middlemen who process your silver can no longer access cash, when banks withdraw credit from an entire industry overnight, the question is no longer if the system breaks. The question is, what breaks next? Welcome to Silver Radar, the channel where we don't just track silver prices, we track the financial tremors that most analysts choose to ignore. Now, if you've been watching markets long enough to remember when a handshake meant something, when contracts were honored and credit was based on trust rather than algorithms, do us a favor. Hit that subscribe button, because what we're about to reveal isn't speculation. It's documentation of a credit freeze happening in real time, and we want to make sure you're equipped with the information decision makers need. Also, drop a comment and let us know where you're watching from. Are you in North America watching your local coin dealer's shelves empty? Europe, where premiums have disconnected from spot prices? Or perhaps Asia, where an entirely different silver market is emerging? Your location matters, because this crisis is unfolding differently depending on which credit system you're trapped in. Now, let's examine what happens when the plumbing of the precious metals market suddenly runs dry. Saturday, January 24th, 2026. A phone call is made from a coin dealer in Ohio to a refiner in Pennsylvania. The conversation lasts less than 90 seconds. We have 200 pounds of 90% constitutional silver, Mercury dimes, Roosevelt dimes, Washington quarters, all pre-1965. What's your buy price today? Silence on the other end. Then a response that changes everything. We're not buying. We can't buy. Our credit line was pulled Thursday morning. The dealer hangs up, confused, because this refiner has been in business for 37 years. He calls another refiner in Indiana, same response. Then one in Tennessee, same answer. By mid-morning, the pattern becomes undeniable. Across the United States, refiners who have processed constitutional silver for decades are turning away inventory, not because they don't want it, but because they literally cannot access the cash to purchase it. This is not a pricing dispute. This is not a negotiation tactic. This is a credit freeze happening in real time. To understand why this matters, one must understand the refining business model. Refiners are intermediaries. They stand between coin dealers who collect old silver coins and industrial manufacturers who need refined 0.999 pure silver bars. A refiner's typical transaction works like this. Monday morning, purchase $500,000 worth of constitutional silver using a bank credit line. Tuesday through Thursday, melt, assay, and refine the material. Friday, deliver refined bars to industrial buyers. Monday, repay the credit line and repeat. This model requires one critical ingredient: access to borrowed capital. Because refiners don't sit on millions in cash, they use leverage. For decades, this system functioned flawlessly. Banks understood the business. They knew refiners had reliable buyers. They knew the margins were predictable. They extended credit accordingly. But something fundamental has shifted. Starting in mid-January 2026, banks began quietly withdrawing credit facilities from precious metals refiners. A family-owned refining operation in Missouri, in business since 1989, with zero missed payments in 36 years, received a certified letter on January 16th. The letter stated their $8 million revolving credit facility would be terminated effective January 20th. No explanation. No appeal process. Just termination. The owner called his bank relationship manager, a man he'd known for 15 years. The conversation was brief and uncomfortable. It's not our decision. This is coming from corporate risk management. They've flagged all commodity financing. Similar stories are emerging from refiners across the country. Credit lines ranging from $2 million to $20 million, all being pulled simultaneously. All with the same vague justification, regulatory compliance, and capital requirements. But here's what makes this crisis different from a simple business downturn. The refiners being cut off are profitable. They have strong balance sheets. They have established customer relationships. This isn't about the refiner's creditworthiness. This is about the bank's willingness to lend against physical commodities. And that willingness has evaporated. The immediate consequence is a market paralysis. Coin dealers who rely on selling constitutional silver to refiners suddenly have no buyers. A dealer in Texas reported that he has $380,000 in 90% silver inventory. Inventory he purchased from estate sales and private sellers. Inventory he would normally flip to a refiner within 72 hours. But now, he's stuck. Without refiners buying, dealers must either hold inventory or sell at deep discounts to private buyers who can pay cash. The velocity of the market has collapsed. Meanwhile, the pricing structure is fracturing. On paper, COMEX silver futures closed Friday at $113 per ounce, but in the physical market, the story is completely different. Constitutional silver coins are selling at premiums of 35% to 50% over spot, because buyers know that once they sell to a dealer, that dealer has nowhere to refine the material. The supply chain has broken. And here's the critical insight most analysts are missing. This isn't a silver problem. This is a credit problem manifesting in the silver market first. When banks withdraw credit from an entire industry segment overnight, it signals a deeper concern about counterparty risk, about commodity volatility, about their own capital adequacy. The refiners didn't become riskier in January 2026, but the bank's willingness to finance commodity inventories did change. And when credit disappears, even profitable businesses cannot operate. That's the warning embedded in this refusal. When the middlemen can't access cash, the entire system is one step away from seizing completely. Scene 1. 3 weeks ago, a refiner in Arizona made a routine request. He asked his bank to increase his credit line from $4 million to $6 million. The refiner had just secured a new contract with a solar panel manufacturer, a contract worth $18 million annually. Scene 2. The bank didn't just deny the increase, they reduced his existing credit line to zero. Within 48 hours, a thriving business with 23 employees was operating on cash reserves alone. Scene 3. This wasn't an isolated incident. This was the beginning of a systematic unwinding. A credit architecture that had supported the precious metals refining industry for generations was being dismantled in real time. Scene 4. To understand what's happening, one must understand how credit works in commodity businesses. Refiners don't operate like software companies or consulting firms. They deal in physical inventory. Heavy, expensive, physical inventory. Scene 5. A single truckload of constitutional silver can be worth $2 million, or a refiner might process 5 such loads per week. That's $10 million in working capital required, just to keep the operation running. Scene 6. No refiner keeps $10 million sitting in a checking account. They use revolving credit facilities, borrowing on Monday, repaying on Friday, borrowing again the following Monday. Scene 7. This model is called inventory financing, and it's been the backbone of commodity processing for over a century, until January 2026. Scene 8. What changed? The bank's risk models. Scene 9. In December 2025, silver was trading at $32 per ounce. Stable, predictable, boring. Then came the first week of January. Scene 10. Silver jumped to $47, then $63, then $81. By January 15th, it had crossed $100. Scene 11. For most observers, this price surge was exciting. For bank risk management departments, it was terrifying. Scene 12. Here's why. When a refiner borrows $5 million to purchase silver at $32 per ounce, the bank knows exactly how much silver backs that loan. Approximately 156,250 ounces. Scene 13. If silver drops to $30, the bank faces minimal risk. The collateral is still worth $469 million, close enough to the loan value. Scene 14. But when silver jumps to $100 per ounce, that same collateral is suddenly worth $15.6 million, worth 3 times the loan amount. Scene 15. You might think banks would love this. More collateral value means less risk, but that's not how modern banking works. Scene 16. Banks don't profit from collateral appreciation. They profit from stable, predictable interest payments. Scene 17. When collateral becomes volatile, when prices swing 40% in a week, banks face a different problem: regulatory scrutiny. Scene 18. Under Basel III, banking regulations. Banks must hold capital reserves against risky assets. The more volatile an asset class becomes, the more capital must be set aside. Scene 19. In December 2025, silver was classified as a moderate volatility commodity, requiring modest capital reserves. By mid-January 2026, that classification changed. Scene 20. Internal bank memos began circulating, memos that refiners would never see. Memos with phrases like elevated commodity exposure and concentration risk in precious metals lending. Scene 21, one memo leaked to industry sources was particularly revealing. Given the unprecedented price volatility in silver markets and the potential for rapid collateral devaluation, All credit facilities extended to precious metals processors should be reviewed for immediate termination or substantial reduction. Scene 22. The banks weren't concerned about refiners defaulting. They were concerned about their own balance sheets, about regulatory examiners asking why they had concentrated exposure to a commodity experiencing triple-digit percentage gains. Scene 23. So they did what banks always do when regulators apply pressure. They cut off credit, quickly, quietly, completely. Scene 24. But here's the cascading effect most people don't see. And when refiners lose access to credit, they can't purchase inventory from dealers. When dealers can't sell to refiners, they stop buying from the public. When the public can't sell constitutional silver, the physical market freezes. Scene 25. And that's exactly what's happening right now. A credit freeze at the refining level is creating a liquidity crisis at every level below it. Scene 26. A coin shop owner in Nevada described the situation perfectly. I have customers calling me with bags of Mercury dimes, Washington quarters, Franklin half dollars. They want to sell, I want to buy, but I can't, because I know I'll be stuck with inventory I can't move. Scene 27. The cruel irony? Silver prices are at historic highs. Demand for physical metal has never been stronger. But the credit mechanism that allows silver to flow from coins to industrial bars has been severed. Scene 28. This is what economists call a liquidity trap. Not a shortage of silver, a shortage of credit to finance silver movement. Scene 29. And the consequences are now visible in the pricing data. On Friday, January 23rd, COMEX silver futures closed at 113 per ounce. But in Shanghai, the same contract closed at 115. Scene 30. A $2 spread might seem insignificant, but it represents something profound. Two different credit environments. Scene 31. Chinese refiners still have access to credit from state-backed banks. American refiners are operating on fumes. Scene 32. The result? Silver is flowing east, because Eastern refiners can still buy, while Western refiners are paralyzed. Scene 33. One European dealer reported shipping 4,000 kilograms of constitutional silver to a refiner in Shenzhen. Because no American or European refiner would touch it, the credit freeze is literally redirecting global silver flows. Scene 34. And here's the question business leaders must ask. If banks are withdrawing credit from profitable established refiners, based purely on commodity price volatility, which industry is next? Scene 35. Copper, lithium, rare earth elements. Scene 36. Any business that relies on inventory financing, any business that processes physical commodities, is now watching the silver market and wondering if their credit lines are next. Scene 37. Because what's happening to silver refiners isn't about silver, it's about a banking system that can no longer tolerate volatility. Scene 38. And when banks choose stability over function, when they prioritize regulatory compliance over economic activity, the real economy doesn't just slow down, it freezes. Scene 39. This is not a temporary disruption. This is a structural shift. Scene 40. The credit architecture that supported commodity processing for generations is being dismantled. Not because the business has failed, but because the banks decided the risk, no matter how profitable the business, was no longer acceptable. Scene 41. And once that architecture collapses, rebuilding it is nearly impossible. Scene 1. Tuesday morning, January 20th, 2026. A refiner in Michigan opens his email. There's a message from his largest customer, an automotive parts manufacturer that uses silver in electrical contacts. Scene 2. The email is brief. We need 500 kilograms of 999 silver by Friday. Confirmed delivery? The refiner stares at his screen. He has the technical capacity to fulfill this order, but he doesn't have the cash to purchase the raw material. Scene 3. He types a response he never thought he'd write. Unable to fulfill at this time due to supply chain constraints. Supply chain constraints. A polite way of saying, my bank cut me off. Scene 4. Within 3 hours, the manufacturer calls back. Not angry. Panicked. Scene 5. We've contacted 6 other refiners. Nobody can deliver. What's happening? What's happening is simple. An entire industry is discovering that profitability means nothing. When credit disappears, Scene 6. The Michigan refiner had operated for 42 years, 3 generations of the same family. Gross revenue last year, $47 million. Net profit margin, 11%. Scene 7. On paper, this is a healthy business. But on paper doesn't matter when the bank says no. Scene 8. The refiner's operating model required a $6 million credit line. That credit line funded inventory purchases every Monday. Inventory was processed Tuesday through Thursday, delivered to customers Friday, payments received the following week, repaid the credit line. Scene 9. This cycle had repeated without interruption for 4 decades, until the credit line was terminated. Scene 10. Now, the refiner faces an impossible choice. Operate on cash reserves and process small batches, or shut down completely until credit returns. Scene 11. He chose the first option, but cash reserves that could process $6 million in weekly inventory can only handle $400,000. Scene 12. His capacity dropped 93% overnight, not because of equipment failure, not because of workforce issues, because of credit withdrawal. Scene 13, and he's not alone. Across North America, regional refiners are making the same calculation. Scene 14. A refiner in Oregon, established in 1981, processed its last batch on January 17th. A refiner in Georgia, family-owned since 1973, laid off 14 employees on January 21st. A refiner in Montana shuttered operations entirely on January 22nd. Scene 15. These aren't businesses failing due to poor management. These are profitable operations being suffocated by credit contraction. Scene 16. The consequence? Market consolidation at unprecedented speed. Scene 17. Only the largest refiners, those with sufficient cash reserves to operate without credit, or those with diversified banking relationships that haven't been terminated, can continue operating. Scene 18. A major refining operation in Delaware, one of only 7 facilities in North America capable of processing over 100,000 ounces weekly, is now receiving offers from desperate dealers, offers to purchase constitutional silver at 8% below spot price. Scene 19. 8% below spot, in a market where premiums should be 15% to 25% above spot. That's how desperate the supply chain has become. Scene 20. But even this large refiner can't accept every offer, because while they have credit, that credit is capped, and demand has exploded. Scene 21. The refiner's CEO described the situation in a private industry call. We have buyers offering premium prices for refined silver. We have sellers offering discount prices for constitutional silver. And we're stuck in the middle because our credit line, while active, hasn't been increased in 3 years. Scene 22. Translation: even the survivors are constrained. Scene 23. This creates a phenomenon economists call profitable paralysis. The opportunity to make money exists, but the financial mechanism to execute the transaction has been removed. Scene 24. Meanwhile, the downstream effects are spreading. Coin dealers who relied on weekly refiner payments are now experiencing their own cash flow crisis. Scene 25. A dealer network in Florida operates 17 retail locations. Their business model: purchase constitutional silver from walk-in customers, aggregate inventory, sell to refiners weekly. Scene 26. In December 2025, they processed $2.1 million in transactions. In January 2026, they processed $340,000, an 84% collapse. Scene 27. Not because customer demand disappeared, but because they can't sell their inventory to refiners. So they stopped buying from customers. Scene 28. The owner explained it simply. I can't tie up $500,000 in silver inventory that I can't move. I have rent, payroll, utilities. I need cash flow, not metal sitting in a vault. Scene 29. This is the cascade effect in action. Credit freeze at refiners. Creates inventory freeze at dealers. Creates purchasing freeze at retail. Scene 30. And the individuals being hurt most? The general public trying to liquidate silver holdings? Scene 31. A retired couple in Wisconsin inherited 400 pounds of constitutional silver from an estate. Mercury dimes, Walking Liberty $50, silver certificates, appraised value at current spot prices, $127,000. Scene 32. They contacted 11 coin dealers. 9 wouldn't make an offer. 2 offered $71,000, 44% below spot price. Scene 33. The couple was stunned. We thought silver was at record highs. Why is nobody buying? Because the dealers know they can't sell to refiners. Scene 34. This pricing collapse at the retail level, and while spot prices remain elevated, is creating a 2-tier market. Scene 35. Tier 1. Paper silver trading on COMEX at $113 per ounce. Tier 2. Physical constitutional silver being offered at effective prices of $63 per ounce. Scene 36. The spread between paper and physical has inverted. Normally, physical commands a premium. Now, physical is being discounted because it cannot be efficiently converted to refined product. Scene 37. But here's where the situation becomes truly dangerous for businesses. Industries that rely on refined silver for manufacturing are now facing supply shortages. Scene 38. The automotive manufacturer that couldn't get its 500 kilogram order filled uses silver and electrical contact points for safety systems, anti-lock brakes, airbag sensors, stability control modules. Scene 39. Without refined silver, their production line stops, not next month, next week. Scene 40. They've now contacted suppliers in South Korea and Japan, willing to pay 30% premiums for delivery because their entire manufacturing operation depends on grams of silver per vehicle. Scene 41. A solar panel manufacturer in California faces the same crisis. Silver paste for photovoltaic cells. Their inventory is sufficient for 11 days of production. Scene 42. They've placed orders with 4 international suppliers. None can guarantee delivery within 30 days. Scene 43. This is the hidden cost of a credit freeze. It doesn't just affect refiners and dealers, it threatens every industry downstream. Scene 44. Electronics, manufacturing, medical device production, defense contractors all rely on steady supplies of refined silver. Scene 45. And all are now discovering that supply chains they took for granted were actually dependent on credit lines that no longer exist. Scene 46. The business continuity question isn't theoretical anymore, it's immediate. Scene 47. Companies are being forced to answer, what happens when our suppliers can't access credit? What happens when profitable businesses shut down due to financing withdrawal? Scene 48. The answer is becoming clear. Global supply chains fracture. Regional shortages emerge. Prices diverge based on credit availability rather than supply and demand. Scene 49. And businesses that operated efficiently for decades suddenly face existential threats, not from competition, not from technological disruption, but from credit contraction they cannot control. Scene 50. The Michigan refiner, who's opened that email on Tuesday morning, is now considering something unthinkable, selling his business to a Chinese consortium, the only buyers with sufficient cash reserves and access to credit to keep the operation running. That's not a business decision. That's a surrender to financial reality. When credit disappears, even the strong cannot survive. Scene 1 Thursday, January 22nd, 2026. Emergency conference call takes place. Participants include CFOs from 7 manufacturing companies, all facing the same crisis. Their silver suppliers have gone dark. Scene 2. The first CFO speaks. Our refiner in Pennsylvania sent a termination notice, effective immediately. No explanation. We have 9 days of silver inventory remaining. The second CFO interrupts. The same situation. Our supplier in Ohio, 20-year relationship. Cut off Tuesday. Scene 3. This isn't a business meeting. This is a crisis response session, because these executives are realizing something terrifying. Their supply chains weren't dependent on suppliers. They were dependent on their suppliers' credit lines. Scene 4. And when those credit lines vanished, the entire procurement model collapsed. Scene 5. One executive asks the critical question, what's our strategic response? Do we wait for credit markets to stabilize? Do we build inventory? Do we find alternative suppliers? Silence, because nobody has an answer. Scene 6. But silence is not a strategy, and waiting is not a plan. Scene 7. What these executives are experiencing, business leaders across multiple industries will soon face because credit contraction doesn't stop with precious metals. Scene 8. The strategic framework for navigating this crisis begins with one fundamental recognition. This is not a temporary disruption. This is a structural shift in how credit is allocated in commodity markets. Scene 9. Banks have decided that inventory financing in volatile commodities carries unacceptable regulatory risk. That decision will not be reversed quickly or easily. Scene 10. Therefore, businesses must operate under the assumption that credit-dependent supply chains are now unreliable. Scene 11. The first tactical response. Immediate counterparty audit. Every business must map their entire supply chain, not just Tier 1 suppliers, but Tier 2 and Tier 3 as well. Scene 12. The questions to ask are simple, but revealing. Does your supplier operate on credit or cash? If credit, which bank provides that credit? Has that bank shown signs of reducing commodity exposure? Scene 13. A medical device manufacturer in Massachusetts conducted this audit in 72 hours. What they discovered was alarming. Scene 14. Their primary silver supplier. Credit dependent, line recently reduced by 40%. Their secondary supplier, credit dependent, same banking institution as primary. Their tertiary supplier, also credit dependent. Scene 15. They had diversified their supplier base, but not their credit risk. All three suppliers relied on credit from banks now withdrawing from commodity financing. Scene 16. The company immediately contacted a mining operation in Mexico, bypassing refiners entirely, negotiating direct purchase of silver ore concentrate. Scene 17. This approach requires the manufacturer to handle more of the supply chain internally, but it eliminates dependence on credit-constrained intermediaries. Scene 18. This is the new strategic model emerging. Vertical integration driven by credit scarcity. Scene 19. Companies that can afford it are purchasing mining stakes, building their own refining capacity, taking control of the entire supply chain. Scene 20. A solar panel manufacturer in Arizona announced on January 21st a $180 million investment in a dedicated silver refining facility. Construction begins in March. Operational by September 2026. Scene 21. The CEO's statement was revealing. We can no longer rely on third-party refiners who are subject to credit constraints beyond their control. Vertical integration is not a preference, it's a necessity. Scene 22. But not every business can afford $180 million capital investments, so alternative strategies are emerging. Scene 23. Strategy 2, cash reserve prioritization. Companies are liquidating non-essential assets, reducing dividend payments, building cash stockpiles. Scene 24. The logic is simple. In a credit-scarce environment, cash is the ultimate competitive advantage. Scene 25. An electronics manufacturer in Taiwan announced it was converting 30% of its treasury reserves from short-term bonds into physical silver inventory, stored in bonded warehouses. Scene 26. They're essentially becoming their own bank, using cash to purchase 6 months of silver inventory, eliminating reliance on just-in-time delivery from credit-dependent suppliers. Scene 27. This approach carries costs, warehousing expenses, opportunity cost of capital, insurance premiums. Scene 28. But compared to the cost of halting production due to supply chain failure, these expenses are negligible. Scene 29. Strategy 3. Geographic diversification of credit exposure. Some businesses are discovering that credit availability varies dramatically by region. Scene 30. Chinese refiners still have access to state-backed credit. Indian refiners operate in a different regulatory environment. South American refiners face different banking constraints. Scene 31. A multinational corporation with operations in 12 countries conducted a global credit availability assessment. Scene 32. They found that their North American and European suppliers were credit constrained, but their Asian suppliers had relatively stable credit access. Scene 33. The decision was immediate. Shift 60% of silver procurement to Asian suppliers, accept longer shipping times and higher logistics costs, in exchange for supply chain reliability. Scene 34. This represents a massive shift in global trade flows, not driven by labor costs or proximity to markets, but by credit availability. Scene 35. Strategy 4. Collaborative purchasing consortiums. Smaller manufacturers are forming alliances, pooling their purchasing power, buying in bulk to attract suppliers who can still operate. Scene 36. 15 medical device companies formed a consortium on January 19th. Combined annual silver demand, 47 metric tons. They approached a refiner in Switzerland, offered a 3-year contract, prepayment for the first 6 months. Scene 37. The refiner accepted. Because prepayment eliminates their need for credit, the manufacturer secured supply by essentially financing the refiner's operations themselves. Scene 38. This is the future of commodity procurement in a credit-scarce world. Buyers must provide the financing that banks no longer will. Scene 39. But perhaps the most critical strategic insight is understanding what this crisis reveals about the broader financial system. Scene 40. Silver refiners aren't uniquely risky businesses. They're canaries in the coal mine. Scene 41. If banks are withdrawing credit from profitable commodity processors, Which businesses are next? Scene 42, copper fabricators, aluminum smelters, lithium processors, steel distributors. Scene 43, any business that requires substantial working capital to finance inventory between purchase and sale is now potentially at risk. Scene 44, the strategic question for every CFO becomes, how dependent is our business on external credit? Scene 45, companies with strong balance sheets and cash reserves will survive and potentially thrive. Companies dependent on credit lines for working capital face existential risk. Scene 46, this is leading to a fundamental reassessment of corporate financial strategy. Scene 47, for 40 years, the dominant model has been minimize cash holdings, maximize leverage, use credit for working capital, return excess cash to shareholders. Scene 48, that model assumed credit would always be available at reasonable rates to creditworthy borrowers. Scene 49, January 2026 shattered that assumption. Banks demonstrated they will withdraw credit, regardless of borrower quality, if regulatory pressures or risk models demand it. Scene 50, the new strategic framework must account for this reality. Cash is no longer a lazy asset. It's insurance against credit withdrawal. Inventory is no longer inefficient capital allocation. It's protection against supply chain collapse. Vertical integration is no longer empire building. It's survival strategy in a credit-constrained world, and the businesses that adapt fastest to this new reality will be the ones still operating when the next credit freeze comes, because if there's one certainty emerging from the silver market crisis of January 2026, it's this. The next freeze is coming. The only question is which industry, which commodity, which supply chain will be cut off next, and whether your business will be prepared or will be another casualty of a financial system that can no longer tolerate volatility, risk, or uncertainty, even when the businesses involved are profitable, creditworthy, and essential to the functioning of the real economy. That's the lesson of the refiner credit freeze. That's the warning embedded in maxed out credit, and that's the strategic reality. Every business leader must now confront